Welcome back, children. We thoroughly learned about the components of the current account and we learned how we are balancing each and every components of the current account. For example, the export and import of goods, how we balance it. There we have the balance of trade. Export and import of invisible items, services, how we balance it. There we have the balance of invisible items. Receipt of from the unilateral transfers, equalizing the payment for unilateral transfers. There we are balancing the unilateral transfers. Thus we have just written, theoretically we have learned the balancing of all the items of the current account. So when all the items of the current account is balanced, automatically current account as a whole will also get balanced. Once again I'll repeat, if the items of the current account is balanced, automatically the whole current account also will get balanced. Now let us see what is meant by the balance of current account. Balance of current account is nothing other than that whatever topics we have learned previously, we'll just recollect it and we will write it here. That is what I have already written it for you. Just have a look on what I have written here. Balance of current account. In a current account, receipt from exports of goods and services and unilateral transfers. You know what all are the components in the current account. Visible items, invisible items and unilateral transfers are there in the current account as we learned just in the previous classes. So in the current account, receipt from the export of goods and services. Receipt we get only from the export. So don't get confused. Receipt will be there only for export. So all the three items of the current account we are taking together. Which are the three items? Unilateral transfers, goods and services. It's export. The export of all the three items will give us receipt. Export of all these three items will give us receipt. That is what I have written. In a current account, receipt that we are getting with the help of export. Receipt from the export of goods, that is visible items, services, invisible items and unilateral transfers are entered as credit items. I have told you whenever it is a receipt, it has to be entered on the credit side and they represent inflow of foreign exchange. If it is recorded in the credit side, it will be inflow of foreign exchange. So once again, in a current account, there are how many components? Three components: visible, invisible, unilateral. So I am taking the export of all these three items. Export of all these three items means we are getting money by selling that. Therefore, there is inflow of foreign exchange. So it will be recorded on which side? Credit side. That is what I have written here. In a current account, receipt from export of goods, visible items, services, invisible items and unilateral transfers will be entered as credit items because they represent inflow of foreign exchange. That is the first step concerned with the balance of current account. The second step in the balance of current account is, the previous one was export. Now we will take the next one, import. Obviously it will be import. Payment for imports of goods and services and unilateral transfers. Once again I am repeating, current account has three components: unilateral, visible items and invisible items. Visible is good, invisible is services. Payment for, so in the current account, in which account? In current account. In current account, payment for, we are making payment. When we are importing something, we are making payment. The payment for imports of goods and services. Goods means visible items, services means invisible items and unilateral transfers. Payment for all these three. Payment means we are making payment, therefore money is flowing outside. So when money is flowing outside, where we have to record, it has to be recorded on the debit side. So once again, in a current account, payment of import of goods and services and unilateral transfers are entered as debit items are entered as debit items as they represent the outflow of foreign exchange. So once again, in a current account, payment for the import of, we will make payment only for imports of goods and services and unilateral transfers. Goods means visible items, services means invisible items, and unilateral transfers are entered on debit side. They are considered as debit items because they represent outflow of foreign exchange. This is the second thing that we have to mention when we explain about the balance in the current account. Next, the surplus on the current account. When we have the surplus, when the credit items are more than the debit items. Credit means what? Inflow of money is more than outflow of money. When the credit items are more than debit items. So a surplus of current account means credit items are more than debit items. It implies net inflow of foreign exchange. The same thing that we have learned, we are explaining it in different forms. So the surplus on the current account, we have to differentiate it like this because we are discussing with a double entry book system, balance of payment accounting, where we need to know all these aspects. So the surplus on the current account. So current account, if a current account has a surplus, what does it mean? The credit will be more than the debit. All the credit sides will be more than the debit. All the credit items will be more than the debits. Export of goods will be more. Export of services will be more. Receipts of unilateral transfers will be more because more inflow of foreign exchange. Receipts from the unilateral transfer will be more. Inflow of foreign exchange. Understood? Then export of goods and services, if it is more, inflow of foreign exchange. That means credit side. Credit side is more than the debit side. So if the credit items are more than the debit items, we can say there is a surplus in the current account. So it represents what? Net inflow of foreign exchange. Just the next step is just the opposite of this. What is it? Deficit on the current account. Deficit on the current account means what? Debit items are more than the credit items. Deficit. When do we face a deficit? If we are losing money. So deficit in the current account means we are paying money to outside countries. Imports will be more. Import of goods and services. Then payment on unilateral transfers will be more. In such cases, debit will be more than the credit. Payment on unilateral transfer, if it is more, debit will be more. If import of goods and services are more, we are paying money. Outflow, debit is more. So if the debit items are more than the credit items, I hope it is clear. If import of goods and services are more, that means we are paying outside. That means money is flowing outside. That means debit is, money is flowing outside means what? Debit is more than the credit for the import. Understood? So when we are paying for the goods and services, if the import of goods and services are more, if we are paying more, then there will be outflow of foreign exchange. That means outflow of foreign exchange means money is going out from us. So debit will be more than the credit. So deficit on the current account means debit items will be more than the credit items. So it implies what? Net outflow of foreign exchange. So in a current account, deficit on the current account means debit items are more than the credit items. It implies what? A net outflow of foreign exchange. Then what is meant by this balance of current account? Only after explaining the first 3 points, we can understand what is this balance of the current account. A balance between all the items, isn't it? When export of goods is equal to import of goods, when export of services is equal to import of services, when the receipt of unilateral transfer is equal to payment of unilateral transfers, when all these items are equalized, the current account is also balanced. That is what I told you. When the items in the current account is balanced, automatically the current account also will be balanced. So what is meant by balance in the current account? When all the items in the current accounts are balanced, export of good is equal to import of good, export of services is equal to import of services, receipt of unilateral transfer is equal to payment of unilateral transfers. When all these are equalized, there will be balance in the current account. So what is meant by balance in the current account? The net value of credit and debit balance. Both the credit side and the debit side, when it is balanced, we can say there is a balance in the current account. So to be more specific, I told you import of goods and services should be equal to export of goods and services. Then receipt of unilateral transfer should be equal to payment of unilateral transfer. If all these are equalized, automatically there will be balance on the current account. So when a question is asked, what is the balance of current account? That means all the three items in the current account should be balanced. Then we can say there is balance on the current account. So if such a question is asked, you have to explain it from the beginning, where we equalize theoretically all the three components of current account. Then only you can write this conclusion. So you have to explain all those points which I have explained in the previous classes. Hope it is clear to you. Now we will move on to the next topic, that is capital account. I told you there are two accounts for balance of payment. They are current account and capital account. Current account consists of the first three economic transactions of BOP, that is visible items, invisible items and unilateral transfer. Just now we finished. And the next is all the items related to the capital receipts and payments which will come under the capital account. So when we speak about capital account, what should come there? Capital transfers. The fourth component of economic transaction of BOP, capital transfer, will come in the capital account. So what is meant by the capital account? It records all the transactions which causes a change in the assets and liabilities. You will be able to recollect it very well because we have learned in detail in government budget and economy regarding the assets and liabilities. When can there be a change in the asset and the liabilities? Now assets and liabilities will change. That will automatically reflect capital receipt and capital payment. You have learned it. So when we speak about changes in the assets and liabilities, capital receipts and capital payment should come to your mind. Isn't it? Capital expenditure. What do you mean by capital expenditure? Government is spending some money for purchasing the machinery, land. That means it will be a future asset for the government. It is a capital expenditure, purchase of asset. If the government is selling the asset, government is losing the money. Repayment of loans. Borrowings and liability, it is a capital receipt because if government is borrowing money, it will be borrowed at a rate of interest. Government has to repay it in the future by paying the rate of interest. So it is a capital receipt. So all the items which causes a change in the assets and the liabilities will come under this capital account. So capital account records all the transactions which causes a change in the assets and the liabilities. Therefore, we can say when it causes a changes in the assets and liabilities, what should come to your mind? Capital receipt and capital payment, which can be termed under one heading as capital transfers. Now, we will move on to the components of capital account. The components of capital account are divided into 5 items. The 5 items are under this capital account, under this capital transfer. Capital transfer mainly deals with the capital account. Capital account mainly deals with the capital transfer. It has 5 main items. They are private transactions. Second one, official transactions. Third one, foreign direct investment. Fourth one, portfolio investment. And the fifth one is banking capital. We will move on to the first one, that is private transactions. What is meant by private transactions? All the transactions which are undertaken by the private sectors, because in an economy there are two sectors, private sector as well as government sector. So all the transactions which comes under the private sector is known as private transactions. So they will be having assets as well as liabilities. So all the assets and liabilities of private sector will come under the private transactions. So I will read out the private transactions once again. Private transactions include assets and liabilities. It includes all the things which affects the liabilities. It includes all aspects which affects the assets and liabilities of private sector. Whatever transactions which affect the assets and the liabilities of private sector, that comes under the private transaction. Every private sectors will have some kinds of assets that they gain and some kind of liability that they have. It is quite natural. So all those transactions of private sector which causes a change in their assets and liabilities is termed as private transaction. That will come under the private transaction. Now let us give an example of some changes in the assets and liabilities that can happen for private transactions. For example, every private sector receives, they take short-term and long-term foreign loans. Every private sector will be receiving short-term and long-term foreign loans because every private sector, for its existence in the business, existence in the economy, they will be in need of money. Therefore, they may take loans from outside. So when they receive the loan, so private sector, every private sector will be receiving short-term and long-term foreign loans. They may take loans from outside. So when they receive the loans, it will be a receipt. When they receive the loans, it will be a receipt and that will be recorded as credit items. But when they receive the loan, they have to repay the loan later with a rate of interest. So when they receive the loan, it is an asset for them because for the time being they are safe. It is an asset for them. But when they have to repay the loan with a rate of interest, what it will become? When they have to repay with the rate of interest, it will become a payment. So when they have to make the payment, it is recorded as the debit item. So every private sector will have certain transactions that can affect their asset and liabilities. For example, when the private sector receive loan from foreign countries for foreign loans, when they receive it, it is a receipt. It can be added on to the asset side, that is credit side. But whereas when they have to repay it in the future with a rate of interest, money is going out as a rate of interest also. Therefore, it will be recorded as debit item. Next, we will move on to the second item of the capital account, that is official transactions. Just as the private sector is making some transaction, government also makes some transactions. So there will be change in the asset and liability of the government also when they make some transactions just like private parties. That is known as government transactions. So government transactions or official transaction. It is also known as official transaction. So it affects the assets and liabilities of the government. So those transactions which affect the liabilities and the assets of the government is known as official transaction. For example, government borrowing loans from the foreign government. Government also will borrow loan. You have very well learned in government budget. So when and from the foreign government as well as from the international organization like IMF, World Bank, etc. You know it very well. When the government borrows it, when it faces a deficit, isn't it? So when the government borrows these loans, it will be a receipt for the government. Government is receiving. So at that time, it will be a great help for the government. So it will be recorded on the credit side. Money is with us. But when we have to repay this amount, we'll be getting this as loans. But when we have to repay this with the rate of interest, that means we are losing out something additional, then it will be recorded on the debit side. So this is all about the government or official transactions. So any transactions of the government which can cause a change in the asset and liabilities of the government can be termed as official transactions. The rest of the items we will be dealing in the next class. That's all for today. Thank you, children.